Hello friends, how are you? I hope all of you are doing really good. So welcome to Economics of Finance Excellency Batch. I'm your friend, your mentor, Saurav Jindal from KSJ Teaching. So we are going to start with our chapter number 13, that is exchange rate. We are just left with two chapters now, the exchange rate and the capital movements. That's it. Now we are very near to the completion, and these are, this exchange rate is very simple chapter. All of you must have studied somewhere about the exchange rate, right? And in our everyday life, we hear about the exchange rate, isn't it? So this is a very simple chapter. Even a plain reading would give you the understanding that what is exchange rate, what are the things, right? Okay, we'll just try to cover it quickly. What is an exchange rate? He says the foreign exchange is the money denominated in the other than domestic currency. Other than domestic currency. Now try to understand very simple things, sir. If we want to involve in the international trade, there are two different countries who are involved in international trade. Now the two different countries will have two different currencies, right? How to convert one currency into another currency so that the payments can be made, so that the payments can be taken back. Let's say Mr. A goes to USA. Now he wants to buy some goods in the USA, right? He just went for the shopping and he want to buy some goods. He has INR only. He says, I have 80 rupees in my pocket. He goes to USA. And now in the USA, he goes to a market to buy something. That person says that, sir, this is for $1. Right? Now Mr. A says, dollar, I have Indian rupee. Right? Now, if there is no exchange rate, how will he be able to buy the goods? Right? If there is no exchange rate, how he will be able to buy the goods? He will not be able to. So the exchange rate is when the value of one currency is denominated in the value of another currency. That is when we can exchange the goods in another currency, right? So exchange rate is the price of one currency expressed in terms of number of units of another currency. That for 1 unit, for $1, what is the price that you will have to pay? 80 rupees. Right? Exchange rate represents the number of units of one currency that can be exchanged for 1 unit of another currency. For 1 unit of US dollar, how many rupees you will be requiring? 80 rupees you will be requiring, right? It is also known as the foreign exchange rate. Now, this is what is known as foreign exchange rate, that if you have the dollars, you can exchange it for rupee. If you have rupee, then you can exchange it for the dollars. Simple. It represents the minimum number of units of one currency required to purchase a unit of another currency. That if you want to buy US dollar, you will have to pay how many units? Minimum 80 rupees that you will have to pay in the INR. The value of currency is relative since it is always expressed in terms of another currency. This cannot be an absolute value that it doesn't change. It is a relative value and it can change with the time, right? So there are different types of quotes that we can say how the currency is being shown. One is the direct quote. Direct quote is when we say $1 is equal to rupees 80. Now this is what? This is a direct quote. Direct quote means 1 unit of the foreign currency and the number of units of the local currency. Now this is your foreign currency. This is your foreign currency and this is your local currency. Right? So 1 unit of the foreign currency and number of units of the local currency. This is your direct quote. Now, if you want to convert this direct quote into an indirect quote, the reverse will be applicable. That 1 by $80 is equal to rupee 1. Right? Now, this is your local currency. This is your local currency and this is your foreign currency. Right? So direct quote is 1 unit of the foreign currency and number of units of the local currency, right? And indirect quote is 1 unit of the local currency and the number of units of the foreign currency. So this is what is given. Direct quote is the number of units of a local currency exchangeable for 1 unit of the foreign currency, right? And indirect quote is the number of units of the foreign currency exchangeable for 1 unit of the local currency. Now, whichever currency we are going to take as 1, this is known as base currency. This is known as base currency. and this 80 rupees, this is another currency, this is known as counter currency. This is known as counter currency, right? So here, in case of the direct quote, the foreign currency is the base currency and the local currency is the counter currency, whereas in case of indirect quote, we are defining in terms of the local currency, that 1 unit of the local currency is how many units of the foreign currency. So what is the base here? The base is the local currency. The local currency becomes the base currency and this foreign currency becomes the counter currency. Clear? So this is the base currency and the counter currency. So this is what is given in the base and counter currency. Just go through it once, right? Now the buying rate. Buying rate is the rate at which the exchange dealer will buy another currency. Now let's say, now it is denoted as 1 US dollar is equal to 72 to 74. Now what does it mean? What does it mean? It is written as 1 US dollar is equal to rupees 72 to 74. Now let's say you have $1 with you, right? You have $1 with you, $1. You go to bank and you say that I want to exchange this dollar for rupees, right? The bank says, okay, no issues, or the dealer who is the forex dealer instead of bank, or I can say the forex dealer, right? You go to the forex dealer, you say that, sir, I have $1. I want to convert this dollar into rupees. Forex dealer will say, okay, no issues. I will convert it into rupees. Now, how much money he will pay you? How much money he will pay you? He is buying the foreign, he is buying the dollar. That is why it is known as the buying rate, right? He is buying that foreign currency and going to give you the INR. So this buying rate, buying is from the view of this forex dealer. Now, if he is going to buy $1, how much money he will pay you? He will pay you 72 rupees or he will pay you 74 rupees. Sir, obviously, why he will pay me more? Why will he pay me more? He will pay me 72 rupees. Right? So this 72 rupees, $1 is equal to 72. This is the buying rate. This is the buying rate. Now, take another situation now. Take another situation. Again, it is given to you that 1 US dollar is equal to rupees 72 to 74. Now, again, you go to, again, Mr. A. Let's say Mr. A goes to the forex dealer. And he says, the dealer, I want $1. I don't have $1 now. I need $1. Now the forex dealer will say, okay, give me the rupee, I'll give you the dollar. Now how many rupees he will take? How many rupees he will take? Will he take 72 or 74? Sir, he will take more rupees to give you $1. Now he will take 74 rupees for $1. Now this is known as, now what he is doing? He is selling the dollar to you. He will sell at a higher rate. He will buy at a lower rate. So this 74 is what? This is your selling rate. Right? So under normal conditions, what will be there, sir? Under normal conditions, the selling rate will be higher than the buying rate. Right? Selling rate will be higher than the buying rate. Clear? So this is what is there. The buying rate is the rate at which the exchange dealer will buy another currency. 1 US dollar is equal to 72 to 74. The customer can sell 1 US dollar for 72 rupees. That is a lesser rate. It is also known as the bid rate. Similarly, what is the selling rate? It is the rate at which the exchange dealer will sell the currency. He is going to sell the US dollar. Clear? It is the rate at which the customer can buy a foreign currency, US dollar 70 to 74. A customer can buy 1 US dollar for 74 rupees. You will have to shell out more. It is called as the sell rate, ask rate, or the offer rate. So these are the different names. Now this is how this person is earning. This is how this person is earning. He will take 74 rupees and when it is about taking the dollar, he will pay 72 only. Right? He will pay 72 only, but he is receiving for that dollar, he is receiving 74 rupees. So minus 72, this 2 rupees is the profit that the forex dealer is earning, and that is absolutely legitimate, sir. right? He's providing you the services. So this is the profit that he can earn, isn't it? So what is a unique rate? Unique rate is when there is no difference between the buying and selling rate, then it is called a unique rate or the unified rate. If the buying and selling rate are the same, in that case, it is known as a unique rate or a unified rate. In practice, mostly the selling rate exceeds the buying rate as it includes the commission of the money dealer running the operations. That is what I told you, right? The difference is the commission. Difference is the forex dealer commission. Right? Any doubts? Clear, sir? Now, the next one is the cross rate. Now, what is a cross rate? The cross rate is there may be two pairs of currencies with one currency being the common between both the pairs. For example, you want to, let's say you want to trade in INR with the pound, right? And you do not have the direct rate with the pound. Let's say you do not directly have the conversion rate with the pound. Now you need to find out the common currency between the two. Let's say US dollar is the common currency. So how will you convert it? You will say INR by US dollar, convert it into US dollar multiplied by pound divided, US dollar divided by the pound, right? So this is how, this is known as the cross rate. This is how the cross rate is being taking place. If your local currency does not have a conversion rate with the currency with which you want to transact, then you need to find out the common currency, which is common in your local currency also, which is in your country also, and which is being used in that particular country also. Clear? Example, if the exchange rate is given between A and B as well as between B and C, we can derive the exchange rate between A and C based on the given rates of two pairs, right? So this is A, this is B, this is B, this is C. So you can find out the INR to pound, right? The rate between A and C is called the cross rate. So whatever the rate that you will get between A and C, that is the INR and the pound, that will be known as the cross rate. Clear? So these are the small things. These are important. These can be asked in the examination. 2 or 3 can be asked in combination. Now, the exchange rate regimes. Now, exchange rate regime is the system through which the country manages its currency in relation to the foreign currencies. That how the various systems, how it is decided that $1 has to be $1 has to be 80 rupees. Right? How these systems are being developed? What are the various systems? There are basically 3 systems, right? Under which the one currency is being managed against the another currency. It refers to the method through which the value of the domestic currency in the foreign market is determined. That how we can determine that what is the value of Indian rupee in relation to the US dollar? What is the value of Indian rupee in relation to the British pound? Right? What is the value of Indian rupee in relation to the Chinese yen? Isn't it? Okay. So there are basically broadly 2 types, but another type is also there. Right? So it is the types of exchange rate regime. The first is the floating or the flexible exchange rate. Now, what is floating or flexible? The flexible means that it keeps on changing. It is not a fixed rate. We say that $1 is equal to rupees 80. Now it is fixed that you cannot change it. No, sir. Floating says it keeps on changing, depending upon the market conditions of demand and supply. If the demand is more, this rate can go up. Right? If the demand is more, this rate can go up. If the demand is less, this rate can come down. So floating or the flexible exchange rate is the exchange rate which is determined by the market, that is based on demand and supply forces. Nobody is having the control over it, right? There is no predetermined target rate, and the value of currency tends to be volatile. Volatile means it can keep on changing very frequently. Right? So it is totally dependent upon how the demand and the supply in the market is being regulated, how the demand is there or the supply is there. So it is quite volatile. Volatile means it can frequently change. It can change in the seconds. It can change in the minutes. There is no interference from the government or the central bank in determining the exchange rate. Any intervention is aimed at preventing the undue fluctuations in the exchange rate. So they say otherwise the government or the central bank cannot intervene in this. But the intervention can be at a very acute stage when they feel that now this fluctuation in the exchange rate is quite unfair, undue, right? It was not required, but still the fluctuations are there. We need to control it. Okay. Such type of exchange rate system is followed in all the advanced and some large emerging market economies. So where they are expecting to be quite a stability in the advanced countries or in the at the emerging countries which are at the advanced level, this floating exchange rate is can be determined, right? This regime has the greater policy flexibility because it is dependent upon the market without any interference. So flexibility is there, but at the same time, the stability is not there, right? That is why we say it is quite volatile. It can keep on changing. It is not going to be stable. Advantages: the central bank or the government can pursue its own independent monetary policy, which is not dependent upon this exchange rate. Allows the exchange rate to be used as a policy tool. The central bank is not required to maintain huge foreign exchange reserves, right? Argued to be transparent and highly efficient regime, clears the imbalances in the forex market without intervention. So what are the disadvantages? The volatile exchange rates generate uncertainties and add to the risk premium. Obviously, they are volatile. There is no stability in that. The volatile rates can also cause the instability and huge losses if not controlled. That is quite obvious. Just go through it once. What is more important is that you should know what is a floating exchange rate regime, right? The second regime is the fixed exchange rate regime, also known as the pegged exchange rate regime. Now, pegged is when you are fixing the exchange rate, right? So here the central bank or the government announces its currency's value in terms of another currency or a basket of currencies or any measure of value, for example, the gold. The exchange rates are different than what the forex market would have produced. Now, if the Indian government says, no, from our side, $1 is equal to rupees 75. Now, whatever happens in the forex market, we are going to exchange the dollar at this rate only. The central bank or the government announces it, right? $1 has to be 75 rupees in the forex market, whether it is selling at 80 rupees, at 85, 90 rupees, it doesn't matter, right? Now, the central bank must be willing to buy or sell the foreign exchange reserves as per the situation in order to maintain the fixed exchange rate. Now, if there is a change in the the forex market, then the central bank will have to buy or sell the foreign currency to maintain it at 75. Otherwise, if there is a huge difference, then that might create the problems, right? So, what in this case, what it is being done is the central bank buys the currency or sells the foreign currency in the forex market so that the rate somewhere revolves around $1 to 75. That is whatever is the fixed rate basically, right? This regime brings more currency and monetary stability as well as credibility, but lacks flexibility because it is being controlled by the central bank or the government. Advantages: avoids the fluctuation, eliminate the risk and the transaction cost, imposes the discipline on the country's monetary authority and enhances the credibility of the monetary policy. Likely to generate lower levels of inflation, obviously, because the things will remain under control. There will be not too much fluctuations which will increase the prices, which will make the things costlier. Now, if there is a fluctuation, if it keeps on fluctuating if it increases, let's say $1 is equal to rupees 85. Now, what will happen, sir? The prices of the imports have increased. Inflation will increase. People will have to pay more. Encourage the greater trade and investment. Now, what are the disadvantages? Should be ready to intervene whenever required, needs to maintain. So there is extra burden on the central bank, extra activity that the central bank has to do. Maintain the adequate foreign exchange reserves for the intervention. How the intervention is done? That in case this price shoots up, then accordingly the central bank will take the adequate measures. They may sell the foreign exchange, right? So in that case, this central bank has an additional responsibility of maintaining the forex reserves, of maintaining the rate, the foreign exchange rate, right? So that is the fixed exchange rate. Now, the another one is the intermediate exchange rate. That is the mix of floating and floating and fixed. This regime is either inflexible or it has the varying degrees of flexibility that lie between the two extreme regimes, namely the fixed and the flexible. The central bank can follow the hard peg or the soft peg policy, right? What is the hard peg policy? The central bank sets a fixed value for the exchange rate, and hence such policy requires the central bank intervention. The central bank says is hard on the things, right? Is strict on the things. The central bank says this is the value we have fixed and this is the rate beyond which you cannot go, right? And if there is too much of the fluctuation, the central bank will intervene by selling or buying the foreign reserves, right? Soft peg is they are following the soft policy. The central bank is soft hearted. The exchange rate is determined by the market. The central bank says, okay, let this exchange rate be determined by the market. I will go soft on it. But if it is too volatile, then the central bank will interfere. If it becomes too volatile, the central bank feels that it is not good for the economy. Obviously, sir, if the exchange rate keeps on changing very fast, if it is too volatile, then it is not good for any economy, not just India. It is not good for any economy, because in that case, doing international trade will be very, very difficult, right? Then in that case, the banks or the governments have to interfere to make it stable, right? They buy the foreign exchange reserves or they sell their reserves to make that rate basically stable. Now, why there is a volatility? Due to the demand and supply changes only, right? So what the government is trying to do, or the central bank tries to do, is they try to control the demand and supply. How? By buying or selling the foreign exchange reserves. So after that, there is one topic of IMF classification, that is the International Monetary Fund, not Indian, International Monetary Fund classification. Definition of exchange rate regimes. Regarding the exchange rate regimes only, the IMF has given some sort of a classification. The first classification is the exchange arrangements with the no separate legal tender, with no separate, that one foreign currency is the only currency which is being used in a particular country. For example, in Zimbabwe, they don't have their own currency. What is the currency that is revolving, that is used in that? That is the US dollar, right? That arrangement is known as the exchange arrangement with no separate legal tender. Legal tender means the money, their own currency. The currency of another country circulates as the sole tender, or the member belongs to the monetary or currency union in which the same legal tender is shared by the members. For example, the dollarization means the use of the US dollar in most of the countries, in many of the countries where they don't have their own currency, right? The use of US dollar becomes the currency of another country, right, which is circulating as the sole tender. That means it is the sole currency of that country. There is no other currency that is being circulated in that particular country, right? Then is the currency board arrangement involves the implicit national commitment to exchange the domestic currency for a specified foreign currency at a fixed exchange rate, right? Now, if you want to exchange the Hong Kong dollar for the US dollar, so the nationals commit that we will exchange this much quantity at a particular fixed exchange rate. That is the currency board arrangements. Other conventional fixed peg arrangements. The country pegs its currency at a fixed rate to the major currency or the currency basket, where the exchange rate fluctuates within a narrow margin, at most plus minus 1% around the central rate. For example, the Chinese yuan. What they do is the country says we are going to exchange at this fixed rate only, right? Against one currency or against a basket. Basket of currencies means against the many currencies, right? So they say this is the fixed rate that we are going to provide to one currency or the multiple currencies at a fixed rate only. The maximum, if it is going to fluctuate, the maximum fluctuation can be plus minus 1% only, not more than that, right? So it is a fixed peg, and this is a hard peg. If you look at it, if it is a hard peg, right? It is other conventional fixed peg arrangements. Then is the pegged exchange rate with the horizontal bands. The value of the currency is maintained within the margin of fluctuations around the formal fixed peg, which are wider than plus minus 1%. It is similar to this one, but here the fluctuations can be more than plus minus 1%. In the first case, that is the conventional fixed peg arrangement, we say if there is a fluctuation, the currency exchange rate is fixed. If there is a fluctuation, that will be within the range of plus minus 1%. In this, we say the fluctuation can be plus minus 1%, but it will be within the range fixed, right? Within the acceptable range, within the margins of fluctuations, right? So margin of fluctuation says that it can be around 4%. So it can be more than 1%, but not more than 4%. That is the maximum limit of fluctuation. Margin of fluctuation means the maximum limit of fluctuation acceptable. Then is the crawling peg. The currency is adjusted periodically in the small amounts at a fixed pre-announced rate in response to changes in the certain quantitative indicators, that we keep on adjusting the currency value in the small amounts, right? A little bit of in the points we adjust the currency value. So that is known as the crawling peg. Then is the crawling bands. The currency is maintained within the certain fluctuation margins around the central rate that is adjusted periodically. Now it is similar to the crawling peg, but in case of the band, the fluctuation will be more than the crawling peg, right? In case of crawling bands, the fluctuation will be little more than the crawling peg. In case of crawling peg, it is the fixed rate, right? In case of crawling band, the fluctuations can be there little bit than the when it is being adjusted. Then is the managed floating within the pre-announced path for exchange rate. The monetary authority influences the exchange rate movements through active intervention without specifying the pre-announced path for exchange rate. Now there is no pre-announced rate or the pre-announced path that this is the action we are going to take. The monetary authority within a few days or within a few hours, they can take the action. They will take the action and then announce it, right? The action is towards what? Influencing the exchange rate. If the monetary authority sees that the exchange rate is getting too volatile, which is not good for the economy, they will take the action immediately without announcing in priority that what they are going to do. Independent floating. The exchange rate market is determined with any intervention aimed at moderating the rate and preventing the undue fluctuation rather than at establishing a level for it. For example, the US dollar, Japanese yen. Independent floating is they can determine, but the intervention is only when it is aimed at moderating or preventing the undue fluctuations, right? This is what we have studied in the floating exchange rate, right? So this is the IMF classification. You have to go through it once or twice or thrice and you have to remember what is there, right? The understanding part we have done, that what is there, the understanding part is done. It is important now that you remember these small things. You will have to, for that, what you have to do is you have to read it multiple times. The more you read, the more you will remember the things. And you know why these books have been made in the tabular form and all those things? Because in that case, in the examination, it is difficult to remember the whole paragraph. But in the examination, sometimes the mind strikes, okay, so this was the table. In this table, it was the third point written in this way. That is why these books have been developed in such a way that it is somewhat easier for you to remember the topics, and sometimes that presentation strikes your mind in the examination. Instead of the paragraph presentation, such presentations can strike your mind, right? That's why we say it is important to have the books. Now, rest of the part we'll continue it in the next lecture. We have the nominal and the real exchange rate. The effective exchange rates are there. Then we have the foreign exchange market, which is very simple, sir. Not at all difficult. Arbitrage process there. Types of transactions are there. Then demand for forex, supply of forex. Then how this rate is being determined. Then changes in the exchange rate. Now, for this changes in the exchange rate, what I will do is I will just give you the overview of how the changes impact the economy, right? What is the impact on the changes? How it is going to impact the economies? Why there are changes under the fixed rate or under the floating exchange rate? So we'll discuss this, right? And I will give you the overview that how the currency will behave if it depreciates, how it will behave or impact the economy if it appreciates, right? So in the next lecture we'll try to cover up this whole chapter, right? Then you will have to read it from here. Then you will have to read it from the book once I give you the overview, right? So we'll try to cover it up. Let's see if we are able to do it or not. Most likely we'll be able to cover this chapter in the next lecture and complete it. After that, we'll be left with just one chapter on time completion for the course, right? So see you guys in the next lecture. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.